Welcome to our guide on required minimum distributions, commonly known as RMDS. These are mandatory withdrawals from retirement accounts that play a crucial role in retirement planning. Understanding RMDS is essential for anyone with tax-deferred retirement savings, as they directly impact your financial strategy during retirement years. Throughout this video, you'll learn what RMDS are, when they begin, how to calculate them, and the consequences of not taking them on time. Required minimum distributions are mandatory withdrawals that the Internal Revenue Service requires you to take from certain tax-deferred retirement accounts once you reach a specific age. The government deferred taxes on your contributions and earnings for years, and now they want to ensure that these funds are eventually taxed. RMDS represent the minimum amount you must withdraw each year. You can always take out more than the required amount, but you cannot take less without facing penalties. RMDS apply to several types of retirement accounts. Traditional IRAs are subject to these mandatory withdrawals. Your 401k plan requires RMDS unless you're still working for that employer. 403b accounts, typically used by employees of public schools and certain nonprofits, also require RMDS. Finally, 457b plans, which are deferred compensation plans for government and certain nonprofit employees, are subject to RMDS as well. It's important to note that Roth IRAs do not require RMDS during the owner's lifetime. The age at which you must begin taking required minimum distributions is 73 years old. This age was recently updated due to the Secure 2.0 Act. If you were born in 1951 or later, your RMD starting age is 73. This gives your retirement savings a few extra years to grow tax-deferred compared to previous rules. Remember, this is the age by which you must start taking distributions, though you can always begin withdrawing earlier if needed for your financial planning. Calculating your required minimum distribution follows a straightforward formula. You take your account balance as of December 31st of the previous year and divide it by a life expectancy factor. This life expectancy factor comes from the IRS Uniform Lifetime Table, which provides a divisor based on your age. The table assumes a certain number of years you're expected to live, and this number decreases each year as you age. Most financial institutions will calculate this for you, but it's important to understand the basic methodology. Let's walk through a practical example. Suppose you have an account balance of $500,000 and you're 73 years old taking your first RMD according to the IRS Uniform Lifetime Table. The life expectancy factor for age 73 is 26.5. When you divide $500,000 by 26.5, your required minimum distribution equals $18,868. This is the minimum amount you must withdraw from that account during the year. Timing is critical when it comes to required minimum distributions. For your very first RMD, you have until April 1st of the year following the year you turn 73. This gives you a little extra time to prepare. However, for all subsequent years, the deadline is December 31st of each year. Keep in mind that if you delay your first RMD until April 1st, you'll need to take 2 distributions that year. One for the previous year by April 1st, and another for the current year by December 31st. This could push you into a higher tax bracket. The penalty for failing to take your required minimum distribution is substantial. If you don't withdraw the required amount, or if you withdraw less than required, you'll face a penalty of 25% of the amount you should have withdrawn but didn't. This penalty was recently reduced from 50%, but it's still significant. For example, if you were supposed to withdraw $20,000 but took nothing, you'd owe a $5,000 penalty in addition to the regular income taxes. That's why it's crucial to track your RMD deadlines carefully and ensure you meet them each year.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.